Well, good afternoon, folks. My name's Tony Hixon, coming to you from Hixon Zuercher Capital Management here in Findlay, Ohio, on a beautiful day. It's Wednesday, June 10th, 2015, and I'm bringing you our monthly economic and market update covering the month of May 2015. Pretty excited today. We're wrapping up a good week here, heading on vacation pretty soon with the family, so looking forward to a little rest and relaxation coming up for myself. To talk about the month of May, what really drove markets was that common theme that we've seen over the past few years, which is the threat of rising rates. And Janet Yellen had made a few statements that drove some volatility throughout the month, and therefore we saw markets kind of on a up and down keel for the month. They really didn't go much of anywhere, neither up nor down. So what's the big deal with interest rates? You know, we think back to when the Fed actually decreased interest rates to 0%, 0 to 0.25 during the emergency financial crisis in 2008. Well, it's been 7 years. Why haven't they increased interest rates yet? Well, we think about what interest rates affect. First of all, they affect bond prices. They affect mortgage rates. They affect corporate lending. They affect many different areas of the financial market. So it is really a big deal, and we need to keep our eye on the trajectory of where interest rates are going. So if interest rates will rise, how does that affect bond prices? Well, if you own a bond and it's at a particular interest rate, and new bonds that are coming to market have a higher interest rate, well, your bond isn't worth as much anymore, so it'll actually decline in value. So that's why a bondholder needs to be very cautious and aware of how interest rates will affect their holdings. How about mortgages? Why would a raise in interest rate affect that? Well, as people buy new homes and issue new mortgages, their payments go up. And the more their payments go up, the more they have in debt, the less they're able to spend in the economy. And with 71% or 70% of our GDP driven by consumer spending, we can see that a raise in interest rates or a raise in debt payments for mortgages or automobiles or credit cards, they'll affect how much money is available to spend in the economy. Next, it might affect inflation. Why does it affect inflation? Well, because when the interest rates are low, there's a lot of more money to go around. We're buying more things. We have more money to spend. And if inflation gets out of control, that is why the Fed will want to start increasing interest rates. They don't want to have too many dollars chasing too few goods. So at this point, they're thinking of potentially increasing interest rates to tame down inflation in the months and years ahead. So we've got our eye on that. Why wouldn't they increase rates? Well, they're looking at economic data, and some of the news that came out during the month of May, consumer spending was down just a little bit. We had a GDP revision for the first quarter. We saw that the economy shrank by 0.7%. So these were causes for concern and what caused some volatility through the month. Well, we know that the first quarter of 2015 was very cold. Walking into work, my face hurt a lot of the times. And so what we've been able to do is realize that the winter drove a lot of the reason why people weren't getting outside and spending money. The second thing, there were some strikes over on the West Coast. Ports were being shut down, and so the goods were not being delivered into the country very well. There was a strong U.S. dollar, and with a strong U.S. dollar comes the foreign goods are less valuable. And so a lot of different variables were at play as to why our gross domestic product may have shrank. But I think they're all very explainable, and we're looking forward to a very robust growth here in Q2. The quarter will end here in 10-15 business days. We'll be interested to see how those new numbers look. Right now, economists are forecasting anywhere from 2.5% to 3.5% in GDP. Also, the jobs report just came out last Friday. It said that the economy added 280,000 jobs. It's a really strong report. And the Fed is really looking at the jobs number before they will even consider raising interest rates. So with that in mind, we think that fall, maybe early spring next year, rates will begin to rise. And so we've got a position in our client portfolios to make sure that our bond holders will do well in a rising interest rate environment. That's the wrap up for May 2015. Thanks for joining us today. If you have any questions about anything that we've discussed here today, please reach out and give us a call at 419-425-2400. Again, this is Tony Hixon with Hixon Zuercher Capital Management signing off for today, June 10th, 2015. I hope you all have a great rest of the week. Take care.